Over the past 48 hours, the global financial world has been hit by a coordinated economic and geopolitical shockwave. President Donald Trump drops a bombshell declaration, a 100% tariff on all Chinese exports, effective immediately. That's the political story. The financial story. A historic, cataclysmic crypto crash that vaporized nearly $1 trillion in total market value, triggered the largest single-day liquidation event ever recorded, and sent Bitcoin tumbling below a key psychological level. The question everyone is asking is this: why? Why did a trade tariff, a move targeting industrial goods and tech exports, send the world of Bitcoin, Ethereum, and meme coins into an unprecedented tailspin? We're breaking down the three distinct but connected factors: the geopolitical spark, the crypto market's fatal flaw, and the unseen tech supply chain that binds them both. Let's start with the flashpoint: President Trump's sudden, aggressive trade escalation. The key document here is the statement, primarily delivered via Truth Social, which didn't just threaten, but declared a 100% tariff on virtually all Chinese exports. The justification: this wasn't a random move. Trump cited China's recent export controls on rare earth minerals and critical software as the primary catalyst. For those unfamiliar, rare earths are essential inputs, the lifeblood of modern technology. We're talking about components necessary for everything from iPhones and electric vehicle batteries to advanced military hardware and, critically, semiconductors and advanced crypto mining equipment. The president argued that Beijing's move was an unprecedented and aggressive act of economic warfare, essentially holding the global tech supply chain captive. The 100% tariff, he argues, is a necessary and proportionate response, a move to force China to back down and secure America's supply of strategic materials. As one economic advisor put it, this is no longer about balancing a trade deficit. This is about national security and industrial control. The news did what it always does: traditional markets hated it. The S&P 500 and the Nasdaq plunged almost immediately. Why? Because the market fears two things: supply chain disruption and escalation. A 100% tariff means higher prices for consumers, massive uncertainty for corporations like Apple and Tesla who rely on Chinese manufacturing, and the real risk of a swift, punishing Chinese retaliation. This created a profound risk-off environment. Now, let's connect the dots to crypto. Why does a tariff on manufactured goods equal a multi-billion-dollar crash in decentralized digital assets? The answer lies in two words: liquidity and leverage. Crypto, specifically Bitcoin and Ethereum, has matured from a niche technology to a recognized, albeit volatile, macro asset. It is no longer isolated. When global markets panic and investors hit the sell all button on risk assets, stocks, tech, commodities, crypto now gets lumped into that same risk-off basket. The geopolitical fear is contagious. This is the main driver of the extreme plunge. The crypto market is notorious for its extreme leverage. Millions of retail and institutional traders use borrowed money to amplify their bets, known as long positions. When the price of Bitcoin and Ether started falling due to the macro fear, these leveraged positions began hitting their liquidation price. Data from CoinGlass showed over $20 billion in leveraged positions were liquidated in less than 24 hours. Think of it like a chain reaction bankruptcy. When a large leveraged position is automatically sold by an exchange to cover its losses, it forces the price down further, triggering the liquidation of the next position, and so on. This mechanical, forced selling, the liquidation cascade, is what turned a normal correction into a historic crash. And there's a more direct link: the tariffs target. If China restricts rare earth minerals, it directly impacts the production of advanced semiconductors and mining rigs, the physical hardware required to run the crypto ecosystem. An escalating trade war threatens the cost and availability of crypto infrastructure, adding an extra layer of structural fear to the sector. This is a very real, existential threat to the profitability of miners globally. To truly understand the damage, you have to look beyond Bitcoin. While Bitcoin and Ethereum took heavy hits, it was the smaller, more speculative assets, the altcoins and meme coins, that saw complete annihilation. Bring up altcoin crash graphic. XRP plunged over 22%. Dogecoin and other meme coins, including one linked directly to President Trump, were decimated by 30% or more. Why? Because these assets carry even higher amounts of retail and speculative leverage. When the market moves, they act as the high beta version of the crash. They fall harder and faster. Adding fuel to the fire are serious accusations of insider trading. Reports surfaced of an anonymous, deep-pocketed wallet placing a massive $200 million short position on Bitcoin and Ethereum just 30 minutes before Trump's tariff announcement hit the airwaves. Did someone get a tip-off? While there is no conclusive proof, the timing has sparked outrage and calls for an SEC investigation, highlighting the often opaque nature of high-stakes crypto trading. As of this recording, the market has seen a slight, tentative bounce. Bitcoin has recovered a portion of its losses, trading back above the psychological $110,000 mark. But the volatility is far from over. The market outlook: analysts are split on what this crash means for the long-term cycle. The structural reset view: this camp argues the crash was a necessary purge of unhealthy leverage. The market is now cleaner, less speculative, and poised for a healthy recovery once the geopolitical dust settles. They view this as a buy the dip opportunity. The macro integration view: this more cautious camp sees the crash as proof of crypto's fundamental shift. It now moves like a high-risk tech stock, deeply intertwined with global risk-off sentiment. Its price will now be constantly hostage to US-China relations, Federal Reserve policy, and global inflation. The fate of the crypto market, ironically, now rests largely on the next post from President Trump. Will he hold the line on the 100% tariff, or will he soften the threat to force China back to the negotiating table? Any signal of de-escalation could trigger a massive relief rally, just as quickly as the threat sparked the crash. Investors are no longer just watching exchange flows, they are glued to political news. So, there you have it. The biggest crypto sell-off in history was not caused by a hack, or a faulty smart contract, or a fundamental flaw in blockchain technology. It was a direct result of a calculated political move to escalate the US-China trade war over critical technology inputs. The 100% tariff created macro panic, which was then hyper-amplified by a market that allowed for irresponsible levels of leverage, leading to the catastrophic liquidation cascade. This crash is the ultimate wake-up call. It proves that in the modern global economy, everything is connected. Geopolitics isn't just news, it's a trade signal. And if you're trading crypto, you are officially in the global macro business. What do you think? Was this a calculated move by the administration, or a reckless gamble that cost millions of investors their savings? Let me know in the comments below. And if you want to stay ahead of these lightning-fast market movements, hit that like button, subscribe, and ring the bell. We'll be tracking every development. Thanks for watching.